Hey, what's up, investors? Today we're going to talk about inflation and stocks. How does inflation affect the stock market and why are stocks going down? Let's take a look. So, first, let's look at our market barometers. Dow is down 1.99% today, so almost 2%. Nasdaq is down 2.67% today, and then the S&P 500 is down 2.14%. Just looking at the index averages does not give you a very accurate picture of what's going on underneath. So I look at the individual stocks in the stock market. These are all the stocks of the US stock market. We can see that the mega caps are down quite a bit. Amazon down 2.323%, Apple down 2.49%, Microsoft down almost 3%, Tesla down more than 4%. Google down 3%, so the mega cap names have been hit quite hard. So what's not down today? It's the healthcare stocks and the energy stocks. Energy, oil and gas integrated stocks are okay. They're not down as much as the rest of the market. Then we have oil and gas midstream, which are doing reasonably well too. And then we have exploration and production stocks. Financial stocks have not been hit as hard as some of the other stocks. Most of the carnage seems to have been in more of the growthier names like Tesla or some of the SaaS names. So the thing that's hitting the market these days is inflation data. In fact, BLS reported a press release today which reported inflation over the past 12 months of 4.2%. This is a pretty big number compared to the historical averages that we've been seeing in the past. So let's take a closer look at the press release. So it says the index for used cars and trucks rose 10% in April, which is a pretty big number. The index for all items less food and energy rose 0.9% in April, which is the largest monthly increase since April 1982. The all items index rose 4.2% for the 12 months ending April, a larger increase than the 2.6% increase for the period ending March. Wow. And you can look at the 1 month percent change in CPI for all urban consumers seasonally adjusted from April 2020 to April 2021. And you can see that April 21 had a very big spike here of 0.8%. Looking at the 12-month percent change chart, you can see that it was quite flat until January of this year, and then it started to take off. Scrolling down, you can see some of the items in this chart are affected quite a bit. For example, energy is up 21%, energy commodities up 47%, fuel oil up 37%. These are all pretty big numbers, but note that 2020 was a pretty bad year for energy and oil prices, so we're coming off of a pretty low base for energy. The rest of the press release is not that interesting, but it contains a lot of data, and I'll link it in the YouTube description so you can take a look for yourself. And here's a chart of the long-term inflation since 2010 or 11. You can see that inflation was very tame for the past 10 years and now it's starting to spike up. Anyway, the question on your mind is, why is high inflation bad for stocks? So let me go into that a little bit. The theoretical value of a stock is determined by a formula called discounted cash flow formula. And it basically says that the value of a stock is the sum of all the future cash flows of the stock discounted at an appropriate rate back to the present. That means the value of a stock is the cash flow produced in year 1 divided by the inflation rate plus the cash flow produced in year 2 divided by the inflation rate squared plus ... and so on, the cash flow produced in year n divided by the inflation rate to the power of n. So you can see when R goes up, which is the rate of inflation, the discounted cash flows go down, which means the theoretical value of a stock goes down. But there's another interesting thing to note here. Another consequence of this formula is the farther out your cash flows are, the more they'll be affected by inflation. For example, if you have a growth stock that is not producing any cash in year 1 and no cash in year 2, let's say it's producing its first cash flows after year 10, after building out the business, then the value of the stock will be the cash flow in year 10 divided by 1 plus R. Let's say the inflation rate is 4%, 1.04 to the power of 10. So the farther out your cash flows, the more you're affected by inflation negatively. And this is being reflected in the stock market by investors. If you look at the performance of stocks in the past 1 week, you will find that the stocks that have been hit the hardest are the growth stocks. For example, look at Trade Desk. It's down 21% over the past 1 week. Uber is down 15%. Snowflake is down 10%. But the stocks that are more value oriented, like the financials or the energy or healthcare, they're not down as much. So to summarize this video, inflation affects all stocks negatively, especially those with far out cash flows. They are affected more than the stocks that have more near-term cash flows, which are the value stocks. So growth stocks are hit harder than value stocks. And this is because their future cash flows are farther out than value stocks. And when you discount them back to the present at a higher rate of inflation, you get a lower number. Thank you for listening and good luck with your investments.